This is the second of our three-part interview with RateSetter, and in this video we're going to concentrate on risk. Now, if you invest with a peer-to-peer lender, you're doing so to get a little bit of extra return. But in order to get that, you must be taking a bit more risk. So it pays to find out in detail what those risks are. So here we go. So those are the returns. Maybe we could turn a little bit to the risks now. Some people have asked whether the money's being lent to people and companies, or whether you're also taking some risk with RateSetter. So say, for example, RateSetter were to go bankrupt. I'm not saying that's going to happen, but it's something you have to consider when you're an investor.
Absolutely.
What kind of counterparty risk is somebody who invests with RateSetter taking from your credit risk?
So that's an excellent question. I would say there are three risks that an investor has to consider before putting money into RateSetter. The first risk is credit risk, and that would be that when money is invested into RateSetter and is lent out to borrowers, how comfortable is the investor that RateSetter is performing their due diligence before giving money to the borrower, and therefore that the loans will perform well. That's essentially the quality of the investment. Is it going to perform? The second risk is the risk of access. So like I said, the money that is invested in RateSetter is not in a RateSetter account. It is out with borrowers who will be returning it monthly, but at that moment in time, it is not with us. So if you as an investor want to access your money right now, there is a chance, and hasn't happened to date, but there is a chance that right now there isn't another lender who is ready to step in and take on that investment. Access tomorrow happens if one lender is there ready to take on the investment of another lender. And I should say that happens daily. So we've got currently over £700 million on the platform, and so far we've granted access to over £350 million early. So that is people that are putting money in, requesting to take it out, and then putting money back in again. That is happening daily, and so far we have facilitated £350 million of early withdrawals. So the risk is there, but it's not so much a case of thinking about it as, if I was to think about there has to be another lender there, and I don't know if there's another lender there, well, one can take comfort in the size of the platform. So we're the biggest peer-to-peer platform in terms of number of customers. So the peer-to-peer risk is inherent to the category, or rather, the risk of access is inherent to the category. As an investor, I might choose to invest in the platform with the biggest number of customers because that reduces the risk of access. So the third risk is that the counterparty risk. So the risk that RateSetter may no longer exist, and that I would say is perhaps one of the smallest of the risks, in the sense that it is not RateSetter that has the investment. It's not RateSetter that's holding the money. The money is with borrowers. So we're just a platform that is creating the contract and the platform that is managing the return of the funds. The platform will continue to exist whether RateSetter is managing it or not. So in an unforeseeable scenario where RateSetter as a brand no longer existed, well, all that it requires for an investor to continue receiving their capital and interest and for the investment to perform is someone to step in and manage that transfer, essentially, the return of interest and capital from the borrowers back to the investor.
So presumably a receiver would step in, somebody else would buy the company perhaps, and then maybe they could take over the business.
That's what I would absolutely expect to happen, and that happens frequently in financial services, where a lender is perhaps no longer a viable concern. However, the underlying assets, are still there, and if the assets are performing well, that is the most important thing. because then another lender will see that as valuable, and they'll step in and take it on. So the first and foremost risk that an investor has to consider, I think, is the credit risk. And then the access risk we talked about, as long as one understands that this isn't a super liquid product. It has been to date, but the risk is that it may not be immediately liquid. Then we can take that second box. And then the third one, of course, I think, is they just have to understand that they're really investing in an asset that RateSetter is not holding. It is merely servicing, it's managing as a platform. And if it wasn't RateSetter, it would be someone else who might step in and manage that asset.
Now, you've also got, in order to mitigate the risk, you also have a provision fund, which you build up over time as a kind of war chest to protect your investors. Could you explain a little bit about how that works?
Yes, so that is fundamental to the first risk, the credit risk, because all loans have some inherent credit risk. And if you look at our performance to date, you will see that after £2.5 billion that we've lent out, not a single investor has lost a penny. Well, how can that happen if loans inherently have credit risk associated with them? Well, that's where the provision fund comes in. So the provision fund is a pot of money that covers for bad debt. And it's completely funded by borrowers. To put it very simply, an APR, or the interest rate that is paid by borrowers, of course, covers for poor performance, for credit risk. And that is very much reflected, you'll see, in general, personal finance and the financial services industry, where there are rates for risk. For instance, the rate for a mortgage will be very low. One might expect to currently pay less than 1%. However, the rate for perhaps a payday loan will be much higher. So that is interest that is paid by borrowers to cover the risk of bad debt. So what RateSetter does is it also prices for risk. And that interest that is paid by the borrower that is covering the credit risk is going into the provision fund. And when loans don't perform, the provision fund steps in and pays the investor at the time that they were expecting to get paid. So the investor hasn't so far ever had to experience non-payment or a payment that it was any less than indeed they expected. I'll go back to qualifying earlier, talking about risks, to say that there is a risk that the provision fund in future may not cover all bad debt. And that's why we think about two coverage ratios. We talk to investors about the interest coverage ratio, and that is the provision fund covering, allowing investors to earn the interest rate that they expected to the penny. And then there's the capital coverage ratio, which says we're protecting your capital, and the provision fund will cover the interest that you're expecting, and also as long as interest, the rate of return is adjusted to cover for prolonged a prolonged recession or prolonged poor performance, then the capital coverage ratio is just a measure to show how much deterioration the loan book can tolerate before the capital is touched. Now, we focus a lot on these two rates, and of course they're both important, the interest coverage ratio and the capital coverage ratio. What I think is also useful in the context of investment to think about is the fact that one's investment in many other asset classes, for instance, in equities, which are perhaps quite comparable in terms of if we think of a spectrum of investments in cash, investments in equities, and maybe peer-to-peer in the middle, you might say peer-to-peer is perhaps closer to equities because there is some risk. Well, my money is immediately at risk. My capital is immediately at risk the day I put it on the stock market. And actually, with RateSetter, there's first an interest buffer, and then there's a capital buffer as well. So we see our product very much in the spectrum of that spectrum of cash and equities as being in the middle. You get higher returns, much higher returns than with cash, and you're taking on some risk, but nowhere near as much risk as you're taking in what are very volatile equities.
Okay, so less capital volatility than equity, but there's still that element of credit risk.
Yes.
I hope you found that video useful and informative. Please support us by clicking on the Patreon link, and if you don't want to miss any of our videos, then subscribe to our channel on YouTube.